Hope the Excel sheet is visible. Okay, so we are starting a new problem, whatever that is. We are going to revisit whatever we have done yesterday, and this is available data, meaning wherever you have to really solve a problem, you will have these data available, meaning these are the annual operational data that comes from your books of accounts. Means whatever data you have maintained during the year, you get that data right from the books. And the previous year balance sheet is already there. Ideal 12. Okay. So our job is to prepare the balance profit loss account, then balance sheet, then cash flow statement. So as I mentioned, the first thing that you start doing is you estimate the gross profit, then you estimate the depreciation. For estimating depreciation, you need to know what is the building, plant, machinery, equipment and all that which are already there. So you copy the data from there. I think this is not right. Just a second. Okay, whatever that is, we'll just prepare based on whatever data we have. So you take previous year data, then you add any new purchase, you subtract any sale, etc., etc., and then estimate the depreciation based on given rate. After estimating depreciation, you estimate operating profit. How do you estimate operating profit? Operating profit is nothing but gross profit minus operating expenses. So gross profit is already done, and then you estimate operating expenses, deduct that from gross profit, you get operating profit. Then you deduct interest payment to the bank or interest payment in general, you get profit before tax, you pay tax, and then you get net profit. From net profit you pay dividend. So whatever is remaining, that is retained earning or retained profit, that goes to the balance sheet. It is added to the reserves and surplus. The name may not be reserves and surplus always. It may be retained earning, retained profit, or profit loss account as such, meaning as it is. So before you start, as I said, try to identify operating expenses, or you can start estimating gross profit. So let us estimate gross profit. First item for gross profit is sales. Let's see what is the sales. Sales may be machine sales, that does not come here. Goods sales, meaning whatever is your business, selling grocery or selling stationery or selling software or selling computers is your business. If that is your business, then how much money you earn selling those, that is the sales. If you earn anything else by selling unusual thing, irregular things, like say you sell some furniture, you sell some obsolete machine, these are not part of sales. Okay, so sales is equal to, here our sale of goods is 5,000, it comes there. So our sales during the year is 5,000. Now from sales you have to estimate cost of goods sales, that you deduct from here to get gross profit. Okay, whatever I showed, this is a very simplistic case of gross profit estimation. This applies in case of a retail store, but if it is a manufacturing company, then cost of goods sold estimation is slightly more tricky. Here you will have some unfinished goods, then finished goods, how much of the raw material you have consumed, how much of the unfinished goods you have consumed, how much of the finished goods you have consumed. You have to take care of all of that. That is complex. So I am keeping that for future learning. As of now, we are treating a retail store where there is no goods in process or finished goods. Whatever you buy, those are finished goods. That adds to the inventory. Whatever you sell, that goes out of inventory. And at the end of the year, you are left with closing stock. And then that closing stock becomes the opening stock in the next year. So let us start from here. So purchase of goods, or maybe you can write closing stock. Whatever stock you inherited, let us put this in simple font, closing stock. So this stock was already there. Sorry, it should be opening stock. I'm sorry. So you start with opening stock, and whatever is the opening stock, that is the previous year's closing stock. So this should be is equal to, it should come from the balance sheet. It is here. Closing stock of inventory is our opening stock for the current year. So 60 is the opening stock. Now you started the business on the 1st of April with the opening stock. Now you have purchased many stock during the year. So you write purchase during the year. How much did you purchase? You just pick up the data from, pick up the data from here. Purchase of goods is here. So 24,000 comes straight. Okay. Purchase of goods during the year. So this is a subtotal. These are the stocks which are available to you to sell during the whole year. So 2,460 are the stocks that was available to sell during the whole year. But then as on the close of business, some stock remains. So you need to deduct the closing stock. How much is the closing stock? This must be given somewhere here. Closing stock is 70. So you just pick up the data from here, and this is to be deducted because you did not sell all of this. You sold this minus whatever remains as closing stock. So cost of goods sold during the year is equal to this minus this. That means 2390. This is the cost of goods sold. Therefore, gross profit is equal to, as you know, sales minus cost of goods sold is equal to, something happened, is equal to sales minus cost of goods sold. That means 2610 is the gross profit. So one entry is done. We have got gross profit. We have estimated one of the objective data, whatever, maybe this. Okay. Now next is to estimate operating expenses. One item of operating expenses is depreciation. Another is amortization. Now we have to estimate the depreciation. So let us estimate depreciation. Now we will start with land. Land is not depreciated, and let us see whether we have bought any land. Payment, salary, etc., etc. Land. Let me give a search if I have any land. Yeah, there seems to be a piece of land. This is one land, that is, yeah, purchase of land, 200. This is another, this is here. So only one entry is purchase of land. So you can write away right here is equal to previous year's balance plus you bought something, this. So land becomes 400. This is going to be, this is balance sheet as on this, that is 31/3/2019, and this is, sorry, this is balance sheet as on 31/3/2020. So we have got one entry already done. Land is not depreciable, so we are not considering it here. Now in depreciation, we start with building first. Building. So initially we start with last year account. How much is the building that was there in the previous year? Building is 400. We just pick up the data from there. And if we purchase any building during the year, purchase during the year, if there is any, let us see, building or factory shed or something, if it is there, purchase of goods, construction of factory shed, so it is there. Let us see if there is anything else. Sale of old machine, purchase of computer, audit fee, fresh long-term loan raised, repair, maintenance, utility, R&D expenses, sale, promotion. I don't see any. So purchase during the year is equal to construction of factory shed. It's almost like the same as previous day. And I didn't see any sale. I didn't see any other purchase. So subtotal is equal to 440. Let's not waste time putting formula. Depreciation, say at the rate of 5%. Suppose it is given. So depreciation is equal to this multiplied by 0.05 is 22. Okay, forget about that. Then equipment or machinery. So we start with last year account. Say last year account, you can write it this way, and is equal to, you have to take it from the balance sheet. This is plant and machinery. So equipment, you can write plant and machinery also. It comes from here. Let us write plant and machinery rather. Machinery you can write in short like this. So last year's is done. So purchase during the year. How much is that? Now there may be many. So let us see how much is there. So one is payment of rent, advertisement, purchase of equipment. This is one plus salary, fuel cost, insurance, employee benefit, purchase of land is not, closing stock, transportation, maintenance, legal, purchase of goods, construction of factory shed, purchase of truck. This is another one plus. Then license, amortization, repayment of bank loan, trade, telephone bill, purchase of telephone. This is another one. Plus electricity bill, sale of machine, interest on bank loan, sale of goods, purchase of computer. This is another one. Plus audit fee, fresh loan, trade payable, traveling, stationery, company pays dividend, founders contribution, company pays income tax, house tax, nothing is there, I believe. So this is perhaps the end of it. So this is the total purchase of equipment. So let us delete the last plus sign. So 197 is the total purchase during the year. So let us make a subtotal, and that is equal to this plus this. So we have this total. Now minus, we have to minus sale of old machine, if there is any, that should come here, is equal to. I remember we have done something, sale of old machine. This is the one with book value. I'll tell you why book value is important. Say book value of 47. If the book value would be say not 47 but say 50, that means we are selling the machine at a loss. If the book value is 50 rupees, we are selling at 47, that means we are incurring 3 rupees of loss. Then we have to show that loss in our profit loss account. I'll show you later. For the time being, let us move forward with this. Sale of old machine should be subtracted. So subtotal becomes this minus this. So total machines become this. Again subtotal. Now we estimate depreciation on this like this. Depreciation at the rate of 10%, normally 10% we take on a lump sum, is equal to this multiplied by 0.1, sorry, 0.1 is 85 rupees. So depreciation we got, but here we got the depreciation. Now, just a second. I made something in a hurry. So net value of building. We should do it right here, otherwise we'll forget. Is equal to 440 minus depreciation is equal to this, and this should go to the building here. So this should be equal to this. So we have new building value of 418. Similarly here, net value or written down value of plant and machinery is equal to this minus this. So this should go there. Plant and machinery is equal to this. So I'm populating the balance sheet while I'm preparing this data. Should not be at all surprising. So cash in hand will not come here. Closing stock of inventory, that was the previous year's balance. This year balance is already there. We have seen somewhere. Closing stock is equal to this. So we can write it is equal to closing stock is this, and then populate it there. And while you populate, you can eliminate this guy from here, put it in some color so that it does not keep disturbing us. So we put it in this color. So that is already done in the balance sheet. So we don't need this anymore. So we just eliminate so that our total scope of the work reduces, because this we'll never consider. Similarly, opening stock is also done. If there is something not opening stock, we are done with purchase we are done with sales. So we can also color it this way. We are done with purchase of goods. This will never come to disturb us. So just eliminate so that you don't have to sift through so much of data. Okay, so net value goes to the balance sheet. We want to estimate the total depreciation, and that should be is equal to, very simple, this one plus this one. So we have 107 is the total depreciation. So now that we have the depreciation estimated, let us estimate operating expenses. Before we start putting the formula, was it plus plus plus, let us right away identify them, will be better. So payment of rent, we start with payment of rent, we put that in red color. Advertisement expenses is also should be in red color. Then purchase of equipment is different. When you have already done purchase of equipment, you could put that in a different color, forget about it. Salary is definitely operating expenses. Fuel cost is operating expenses. Insurance, employee benefit, both are operating expenses. Purchase of land is not, and it has already gone into balance sheet. Transportation, maintenance, legal, all are operating expenses. Construction of factory shed is not, that has been considered while putting depreciation, and we have already put that in balance sheet, so we don't have to worry about it. Then purchase of truck is fixed asset. We have taken that while calculating depreciation, and it has already gone there in the balance sheet. So that part is done. License and registration fee is part of operating expense. Amortization and of capital preliminary pre-operative expenses is, as I said, part of operating expenses. Trade receivable is a balance sheet item. Since we have come across this item, we can just write it here. Trade receivable is equal to, is because we identified, we put it here, and something of the balance sheet is done. So we'll be free about that part. And here you have to just put the summation, add it to after the cash flow, so that cash in hand, so that we accommodate this guy also here. And then when we'll do the cash flow statement, it will come there automatically. The sum will take care of that. Now here you see these are done, and then preliminary pre-operative, we could do it right now, but I'm not doing it. Then we get total non-current, total asset. Almost the one side of the balance sheet is done. Okay, repayment of bank loan is a balance sheet item, and that should be done with the long-term loan. You should remember that this is highly connected with the long-term loan. Let me put an arrow here so that we don't make a mistake. Repayment of bank loan is always with the long-term loan. Okay, don't make a mistake. Just remember that it's not related to short-term loan, it's not related to anything else, it is related to long-term loan. So if the long-term loan is this and you are repaying something, whatever, 5, so it should just be deducted. This 5 should be deducted from here, that should come here unless you raised new loan. If you have raised new loan, that is to be added. That we will see moving forward, and then we'll take care. Trade receivable. Receivable. I think we have done already. Receivable 85. Oh, that is done. Sorry. Is it twice? No. So telephone bill payment, this is very much operating expense. Purchase of telephone is not. Electricity bill payment is very much operating expense. Sale of old machine has been considered here. Interest on bank loan comes after operating profit, so it's not here. Purchase of computer is a fixed asset and it has been considered while estimating depreciation. Audit fee is one of the operating expenses. Fresh long-term raise is 50. So now that we have fresh long-term raised, we have the repayment and we have the previous year's balance. So let us complete this block here. Is equal to previous year's balance minus if we have repaid anything plus whatever we have raised. Fresh long-term raise is 50, so we get this done. So another cell is already filled in. Now we have to fill in only this and then balance sheet is done. It's so simple. You should not think it complex, then the whole thing becomes complex. Now fresh long-term loan raise is gone. Trade payable is 105. This is a balance sheet item, remember. So we just populate trade payable wherever that. Here is the place where trade payable is to be written. Just put it from here and it's gone. So this is also populated. Traveling expenses is very much operating expense. Stationery is operating expense. Dividend is not. So forget about that. Founders contribute to new equity that will come both in balance sheet as well as cash flow. So let us do that balance sheet thing. Where is the capital? Owner's equity. Fully paid up equity capital is 638. So this year capital will be previous year's capital plus whatever has been brought in. This has been brought in. So this becomes the new equity capital. Another cell is done. While doing that, you can actually put it in a different color so that identifying becomes easy. Notice very carefully because there is every possibility that you will be writing NSEM in the campus. So if you write NSEM in the campus, there will be a full sum on this, and that will have at least 20 marks out of 100, total 100, and that will carry a lot of weight. In fact, if you do it correctly, a lot of things are done. 20, 25, something like that will be the weight. So because COVID is kind of waning, and today I received a circular from the Ministry of Ministry, I think, whatever, I don't remember. I think MHRD has sent a notice that now things should come back to normal. So you never know when IIT is going to call you back. Already many research scholars are in the campus, whether you know or not. We have invited or we have allowed the research scholars who joined the institute in 2014, 15 and 16. Now, maybe any day there will be another circular to invite those who have joined in 18 and 19, 17, 18. And then if things are under control, meaning that if we do not have a second wave because of vaccine or something, then I predict that before March, maybe in the first week of March or second week of March, maybe you will be back to campus. That's not the brightest prospect. So if you are back to campus, there will be NSEM, physical NSEM. And then this sum will be a complete sum. You have to write the complete sum. So there will be a sum like this. Whatever I am doing, you have to do that on a piece of paper, meaning your answer script. That is why you should learn it very thoroughly. And in the class test, there will be several questions around this, short question. But if you do not understand it holistically, then it will be difficult to really solve. So be careful, be attentive. Outstanding in short-term loan is done. Okay, not done. Outstanding loan so directly goes to the balance sheet, because whatever is the balance with the bank, you just populate it here. Unlike long-term loan, only long-term loan has all those relationships. What are they? Long-term loan comes from here, then raise fresh long-term loan comes here. So these two are taken together, meaning previous year's long-term loan minus repayment plus any loan raised, that comes here. Okay, so these two are connected. Let me take this guy there to easy understand. Okay, now company pays dividend. Dividend comes in the profit loss account at the end, before you estimate retained earning. Companies contribute to new equity. We have already considered it here. Done. Company pays income tax at the rate of 20%. Fine. Outstanding in short-term loan, we have already populated. Postage, accounting and legal fees, bank charges, sales and marketing cost, entertainment cost. These are all operating expenses. Now, non-capitalized research and development expenses is also operating expenses. Let me explain this further. See, if you incur a little bit of expenses under research and development or advertisement or marketing or preliminary pre-operative expenses, these are allowed as operating expense. But if the expenses is huge, if the expenses are huge, then you would like to amortize. You don't want to allow that as operating expenses, because if you do that, your profit loss account will start bleeding, meaning you will incur losses. You don't want to show that. That is why whenever there are major R&D expenses or advertisement expenses, preliminary, pre-operative or anything like that, this can be capitalized. It is your prerogative to do. You can jolly well do that without asking anybody. So this non-capitalized research and development expenses will be shown as operating expenses. Office supply cost, repair maintenance, I think it is repeated, forget about that. Utility expenses like water and some other, that are also part. Benefits, wages to the employees, or maybe whatever, labor, daily labor. Repair cost of equipment may be repeated, forget that. Legal expenses may be repeated 2-3 times. Advertisement again, okay, advertisement. See, this advertisement expenses is substantial. Now it is your decision whether to amortize or to allow in the year. Now 300 compared to 5,000 rupees seems to be quite high, right? At least compared to preliminary pre-operative, that is 500. So this is also 300. So you may like to amortize this. So here you may write that to be amortized in 10 years. Okay, this one is slightly less. So maybe research and development to be amortized not in 10 years. Suppose it is to be amortized in 5 years. That is a decision that you have taken, not that there is a rule or something. Okay, so let us keep it that way. Forget, means don't worry about it now. Now, entertainment cost is very much part of operating expenses. Marketing, sales promotion, internet hosting, web server cost, broadband cost. I kept all of that just to drive home the point that there are so many other kinds of costs that you may not normally look at, you may overlook. When you are thinking of starting a company, you may not have much idea what kind of costs you may end up incurring. Just to have a wider understanding that there are many kinds of costs. So I should rather be careful rather Instead of thinking that I buy at 100 rupees, sell at 120, I make a profit of 20 rupees. It's not like that. There are so many expenses that may evade your eye, and then at the end of the year you'll find that you have incurred maybe not 100 rupees, but you have incurred something like 150 rupees. So you sold for 125 and you incurred loss of 25 rupees. Instead of doing that, if you are familiar with all the expenses, you will not sell at 125. You will strive to sell at 150 and more. So customers may absorb that rather than thinking that that is available free, something like that. So whenever you think of giving freebies or discount, you should have a fair idea of the total expenses. So that is why I have kept so many. Now all those red things are operating expenses. Now we go to estimate operating expenses is equal to first item should be depreciation, because there is a tendency that we may forget about it. So depreciation comes first.
Excuse me, sir.
Yes, go ahead.
So in the ninth row, there is another amortization of capitalized something 19th. Sorry, 19th.
Okay, yeah, very right, very right. I kept it
What is
intention.
that?
I kept it. This is preliminary pre-operative expenses that we discussed yesterday. Preliminary pre-operative, that is the expenses that you incur before starting the company. Suppose today you think that you want to start a company. You don't start it today. You will be starting maybe after 6 months of research, then 6 months of preparation. During this period there will be a lot of expenses. Even company formation requires a lot of investment. So those are actually costs. Those are operating costs. But then if you allow that even before you have any sales revenue or revenue, that is not the right decision. So you want to capitalize that, meaning whatever you have incurred, you have incurred 500. So out of 500, you are allowing 50 rupees to be amortized this year. Last year you have not amortized any, or maybe you have actually incurred 550 rupees. You amortized 50 rupees. Now you are left with 500. Out of that you are amortizing 50. So whatever will be left is equal to 50 minus whatever you have amortized. So this year it will be 430. Now we need another two items. One is amortization of advertisement, or don't write amortization here. You write capitalized advertisement expenses. Capitalized, meaning this is a kind of a revenue item, but you have capitalized that, meaning you have transformed that into capital asset. Even this also has been transformed into capital asset. So you write capitalized R&D expenses. How much this year you have incurred? So this is 300 and that is 200. So this is equal to 300 gone, and this is equal to 200 done. So this is done. And last year there was nothing. Last year there was 0 here and 0 there. Right. Now suppose you decide that even though you have incurred these expenses this year, you want to start amortizing this year itself. So if you are amortizing in 10 years, how much is the amortization this year? 30 rupees. 300 divided by 10. So this does not become 300. This becomes is equal to 300 minus 30 rupees. That means 270. And this becomes is equal to 200 minus how much? Your Total cost is 200. You are going to amortize in 5 years. So annual amortization is 40 rupees. So it should be 200 minus 40 rupees. That means it is 160. This is capitalized advertisement expenses, capitalized R&D expenses. There are 3 similar items. So I just wanted to drive home the point accurately because I want to put a sum on this in the class test. So don't make mistake. That is why I wanted to drive home the point repeatedly. Yesterday I discussed more thoroughly. I am not discussing so thoroughly, but I am giving example. Right. So let us now for depreciation, you mark it red so that we never forget. Even when you have estimated the total depreciation, immediately you just read it so that you know that this is also part of operating expense. So you start here is equal to first is depreciation plus, don't start anywhere here, start from the top, this plus 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 this, all red items, plus this plus this. Now the job is very easy, plus this 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 plus. There may be shorter method, I do not know. Forgive me for that. So it is 914. Operating expenses is 914. Now our gross profit is this, and that is our operating expenses. So now we estimate operating profit.
Sir, isn't amortization added?
Oh, right. Thank you. Who is this?
Balaji.
Pardon?
My name is Balaji, sir.
Balaji, you are very right. We have taken only this part, amortization. We forgot to take this. So instead of doing it mentally, I think we should have done it here itself. Insert and then insert. So amortization, we write amortization of ad expense is equal to this divided by 10. So this is this year's amortization. Similarly, you write amortization of R&D expenses is equal to this divided by 5 because we are amortizing in 5 years. So this guy becomes red. So is this guy. Function F4. Okay. So now this is equal to further plus this plus this. Okay, I think we are complete now. This amortization has already been taken care. This is cell number B19. So here you see B19 is there. Yeah, this is very much coming in color. So we are done. So operating profit is equal to gross profit minus this one is this. This is operating profit. We have healthy profit. Now we have to deduct interest payment to bank. Interest, you can write interest expenses. That is equal to wherever there is interest. Let us know. I remember. See, it is still in blank. So this is the interest after. So operating profit, you can put it in different color just to drive home the point. Then profit before tax. This is equal to this minus interest. So we have 1576 rupees of interest is profit before tax. Again, wonderful. Now income tax. Income tax at the rate of 20% is equal to this multiplied by 0.2 is this 315.2. So net profit is equal to profit before tax minus income tax is equal to 1260 rupees 80 paisa. This is net profit. So we have come up to here. A lot of things are done. Now let us see if the company is paying any dividend to the owners. Dividend payment. And remember we saw something about dividend. It's not here. Companies paid dividend during the year is 20 rupees. So let's say no, profit is quite high. So rather than 20 rupees, let us pay 200 rupees. It's good year. So let us pay 200 rupees dividend. So the company pays dividend is equal to here. And then we get retained profit or retained earning. Earning is an American term. Profit is an Indian term. This minus 200 is equal to this. So our retained profit is 1060.80. This is our retained profit. What goes to the balance sheet is this. What goes to the cash flow statement is this. Remember, yesterday I made this mistake. Just a second. Just a second. I need to come back within half a minute. Yeah, I'm back. So remember this, that in cash flow statement we take net profit. In profit loss, sorry, in balance sheet we take retained profit. Because in cash flow statement we show the dividend payment. That is why we need to start with net profit. If we don't show the dividend, then we can start with retained profit, but don't try to break the tradition. Let us remain as we are. So profit loss account is done. Balance sheet is almost done. What is left is the cash in hand that will come from cash flow statement. And this we can already do because everything is done. So just add them up. It becomes 2463, done. Equity and liability, we have already done. The equity, reserves and surplus should be is equal to, as you remember, previous year's reserves and surplus plus retained profit. It is here. Add them up and we get this. So total owner's equity is this plus this, meaning equity capital and reserves and surplus. So this is also done. Short-term liabilities, trade payable, we have populated. Short-term loan from bank, I thought I populated, so is equal to whatever is given. That is the difference between long-term and short-term loan. Short-term outstanding short-term loan is 250, so it is done. Subtotal is equal to this plus this, done. Now long-term loan we have already done. Then subtotal of liabilities is equal to this subtotal plus long term. We are done 960. Total equity and liability is equal to this one plus this one. So we are done 3433. This side is completely done. This side will be done once we have the cash. Other things are done. As simple as that. Now we have to do the cash flow statement. So we start from here. Cash flow statement for the year 1920. Now cash flow from operational activity. We start, as I said, we start with net profit first. We'll write it here. So net profit comes first. Where is that? Is equal to, as I said, we don't take this, we take this. This goes to the balance sheet. Okay, One thing is done. Then we write depreciation and amortization. We write depreciation first. Amortization we keep separately. Is equal to whatever is the total depreciation is this. We have put it in red so you can identify nicely. Now we write amortization. So amortization, there are 3 entries. So that is why I am putting it separately. Is equal to, one is this plus this plus this, meaning amortization for preliminary pre-operative, amortization for advertisement expenses, amortization for R&D expenses. So we have the total amortization. These are plus because these are non-cash expense. Money has not gone out, but we have shown here as an expense as if money has gone out. So we have to bring back the money that we have shown as if money has gone out, but money actually has not gone out. So we are bringing it back by showing as positive cash flow. Positive, yeah. Then we have to account for any increase or decrease of inventory. If inventory has gone up, then it is a negative cash flow. Let us see first. Cash in bank. Closing stock of inventory. Earlier year closing stock was 60. This year closing stock is 70. That means it has gone up by 10. It has gone up by 10. That means 10 rupees has gone added to here to get this data. That means 10 rupees is the negative cash flow. It has gone away from the company to the stock. We're talking about cash. So cash has gone to the stock. That is why this is a negative cash flow. Whatever has gone up. Then we write about trade payable. Receivable. So receivable is, as you know, you have supplied the goods, payment is yet to be received. Now you actually engage money in that because you manufacture some goods and then you sell, it goes to the customer, money is yet to come. For manufacturing that, you spend money. That means you spend cash. So cash goes in, and if the receivable goes up, more cash has gone in. How much more? This minus this. So it becomes 10. 10 rupees has gone in. That means 10 rupees has gone out of your cash. So it is minus 10. Then trade payable. So payable is the opposite story. Let us see what is the date. What does the data says? Trade payable, earlier year it was 97. This year it is 105. What is the increase or decrease? 8. So our trade payable, if you remember, this arises when you buy something from somebody but you do not pay. That means somebody's money is invested in his stock that has come to your godown without making payment. It is as good as some cash coming in. Last year this data was 97. This year the data is 105. That means 8 rupees worth of cash flow has happened. Cash inflow has happened. That means it is positive cash flow. Okay. These are the total operational cash flow. You just have to remember there's no formula. So you make a subtotal of this. This is the total cash flow from operating activity. Total cash flow from operating activities. Okay. So one part is done. Now financing activity. So cash flow from financing activities, or say investment activities first. Normally we do investment activities first. If you remember, investment activities are those wherein you buy assets, you invest capital in asset. That is why it is investment. Invest money to procure long-term assets. That is why it is called cash flow from investment activities. Okay. So wherever you have invested money, that should be shown here. One is land. If you sell anything, then cash comes in. If you buy anything, cash goes out. So land, last year it was 200, this year it is 400. So 200 worth of land was purchased. So is equal to minus whatever you have purchased, because it is cash going out. Land is gone. Building. Let us see whether we have invested any money in building. That's it. If we have invested, that should come here as negative cash flow because this money has gone out. Okay. Okay. Now building, see, don't go into depreciation and all that, you will get confused. That is why building value should not be taken from here. Should not be taken from balance sheet. Remember this carefully. Building cash flow should not be taken from balance sheet. It should be taken from sell purchase data. Let us see whether we have bought anything. Purchase of land, purchase of equipment, construction of factory shed. This is a negative cash flow under building, minus 40, because this money has gone out because you have constructed a building paying money. So money has gone out. So building is equal to minus this. And if there is any other, that also has to be minused, meaning you have to minus them as well because that is negative cash flow gone. Machinery. Purchase. Let us write here purchase because sale will be shown separately. Is equal to total purchase should be shown here. Purchase of machinery is equal to this plus this should be minus actually. So remember this is minus. Then this also minus because we have purchased more. Purchase of truck minus. Then telephone minus computer. Sorry, this one. I hope there is none. So this should be the total. Everything should be in minus. So it is minus 197. Machinery is done. Is there anything else other than machinery in cash flow from investment activity? I don't think we have bought anything else. So we make a subtotal of this is equal to total of these three cells. This is a total cash flow from, oh sorry, you didn't mention, I also forgot. Do you remember something? We actually sold some machine, right? Sold machinery and that money has come in. So this is equal to sale of old machine valued 47. This money has come in. So that should be positive. Okay. Now the cash, the subtotal or total cash flow from financing activity. Sorry, investment activity. This is investment activity. Is equal to, just make a sum total and that is the one. Then cash flow from financing activity. Okay. So we start financing means one is equity capital that you bring in, you may or may not bring in. Second is long-term bank loan. It may come, it may not come, it may go if you repay. Short-term bank loan, if the outstanding balance goes up, money is coming in. If the short-term loan outstanding is going down, that means the bank has taken money from you. So it should be negative cash flow, right? And then there is dividend payment. Nothing more is there for this sum. There may be for others. So let us write equity capital. Reserves and surplus does not come here. So is equal to, if we have brought in any new equity, founders contribute to new equity is this. So So this money has come in, that is why this is positive. Long-term bank loan. Let us see what happened to the long-term bank loan. See, you have repaid bank loan of 5. So this has gone out. And you have raised fresh loan of, you have raised fresh long-term loan of 50. So you understand that 5 should be minus and this should be plus because this money has come in. So long-term bank loan is equal to, first let us write this which has come in, fresh long-term. And then we subtract whatever we have paid, repayment of bank loan. That should be good enough. You can do it this way. This minus this plus this. That is also possible. And then dividend payment. We have paid some dividend and that has gone away from the company. So this is equal to minus whatever is the dividend. Company pays dividend of 200. Done. So minus 200. I think there's nothing more. Equity capital long term. Now there is a short term loan. Now the short term loan, whatever is the difference in the outstanding balance, that comes here directly. Let us see. Short term bank loan is 250 now. It was 150 previously. So it has gone up. That means we have got some money from the bank. So it should be is equal to this minus this. So 100. If this will be, suppose this is, suppose for whatever reason it has come from cell B38. Suppose this is not 250. Suppose this is 100. Then what happens? It becomes negative automatically because last year the loan was 150. This year it is 100. That means you have paid back to the bank 50 rupees. So that 50 rupees should be negatively shown. For the time being, I'm not showing it that. So it is 100 because loan has gone up. Now we estimate the subtotal. 145. 145 is the subtotal. So we have, this is the total cash flow from in financing activity. Financing activity. Now we have to estimate the total cash flow. Okay, is equal to this plus this plus this. This is our total cash flow. Now add with that previous year's cash balance. Cash balance. This is nothing but you get it from the balance sheet. Previous year it was this. So we get this year's cash position. Total cash. Total cash this year. At the close of business is equal to previous year's balance plus current year's balance becomes this 1315. This goes here. The cash position here is equal to this one. So we get the cash, then we get the total current assets, then we get this guy here, total current assets plus total non-current asset is equal to this. So it becomes 3933.80 and we should means this and this should have matched. We have made some mistake somewhere. Let me see how much is the mistake. This minus this, I think it's 500. So let us see where is this 500 thing. We made a mistake about 500 somewhere. Trade payable is right, subtotal is right, long-term loan is right, subtotal of liabilities. Did we make a mistake in cash flow statement anywhere? 500 rupees. Amortization is this. Depreciation is 107. Is the depreciation 107 only? Yes. Then dividend we have considered. Equity capital is 200. Long-term loan is right. Only 50 rupees minus 5. Then cash flow, previous year's balance is how much? 85 is right. Previous years it is balancing 2020 2020, right? It is balanced. Let me see previous year. If it is wrong, then everything will go wrong. Total current asset. Oh, there is no formula. So we have to put the formula to see if the previous year's values are okay. Now land is this, building is this, preliminary pre-operative is this, machinery pre-operative, capitalization, total non-current asset. Let us put it with a formula, otherwise it will go haywire. Total asset is equal to this plus this. Okay, then paid up equity capital is right, reserves is right, total owner's equity is equal to this plus this. Fine. Then subtotal of liabilities, subtotal of this is equal to this plus this, and then long-term liabilities, this plus this. Long-term liability, long-term loan is subtotal liability is equal to subtotal plus this, sorry. Made a mistake. Is equal to this plus this. So it is 807. This is equal to this plus this. So it is pretty good, meaning 2020 and 2020. Last year it is fully balanced. This year we made a mistake. Land, building, plant machinery, preliminary, capitalized advertisement expenses 270, capitalized R&D expenses 160, depreciation has gone there. So this 500 is from here. It's from here. So did we make a mistake somewhere? Yes. We have not considered that in the cash flow statement. See, this is in investment activity. In investment activity, good that this mistake happened. In investment activity, this also should go. We have invested in R&D expenses. We have also invested in advertisement, and we have not shown that as expense. So the full amount should come here as negative money. So R&D is equal to, yeah, R&D is 200. This should come here. Advertisement also is a negative because the money has gone out. It should come here. So our total operating, sorry, it is not operating, this is investment activity is this, and our this one is equal to this plus, delete it altogether, sorry, not this, this one is equal to this plus this plus this. So this is equal to 730 and this is equal to 85 and this becomes less. So now you see 34, 33, 34, 33.8 exactly matching. There should be no reason why it should not match unless we make a mistake. I hope you understood why this should come here, because we have invested this money. So this money has gone away. So this is a negative cash flow. Okay. I'm actually feeling feverish. That is why I'm speaking slow and not loud. So if there is any question, I'd like to explain. Otherwise, I'll call it a day. Not feeling well. Okay, question, please.
Sir, can you Can you again explain like why depreciation and amortization are positive in cash flow?
Because these are the money that has gone out of your profit loss account. Okay, look at the profit loss account. Is it visible? Excel sheet?
Yes, sir.
Okay, so when you estimated the operating expenses, you have deducted depreciation and amortization, but you have not paid this money to anybody. This money has not been paid to anybody. This money remains with the company, but you have deducted that from profit loss account by including them in your operating expenses. So in a way that money has gone out of your books of accounts, but the money is there in the box or money is there in the bank. So this money has gone away in your estimation. In your estimation, this money is not there. But when you will be counting the cash, you will find that this money is there because you have not paid it to anybody. So that is why you are adding it here so that there is no anomaly between how much cash you hold and how much cash you are showing here. Get this? Is it clear?
Yes, sir.
Okay, great. Anybody else? Any question? I will count maybe 10. Yeah, please.
You explain what does it mean by focusing on equity, or what does founders equity actually mean?
Okay, great. Great. So I don't need the Excel sheet, but then let us remain here. Say put up capital. Suppose you start a business. Suppose you start a business or you want to start a business. So you talk to two other friends that let us start a business. Then you start talking, you start exploring, you have meetings. So you spend a lot of time and you see that you are involved more than others, meaning the idea is yours. You are spending money on travel because you are going there and talking to them. So and you have started talking to the vendors who will supply you the goods. So in a way you think that you are doing more work than others. So you think that I should have more ownership to the company. Now you have a meeting with the friends. Then you tell the friends that, look, guys, you two guys are already doing some jobs and earning some money. I am not doing anything and I am working for the company and I am in fact spending my money. So it is fair that I hold more ownership. They say, yes, yes, we do appreciate. We do a day job and we work for the company in the night. You do not do any day job. You are actually working 24/7 for the company and you will be involving more at the beginning until we quit our job and join. So you should have higher stake in the company. So you take maybe 45% of the company and the other two friends, one of the friends take 35% because he or she also is doing something. You 40%, 45, the other guy 35. So 80% goes and the other guy takes 20%. Okay, that is decided that this should be the share of ownership. Okay, now how this is actually manifested, this you have decided, but how you actually do it. Excel sheet is visible?
Yes, sir.
Okay. Now you talk to a chartered accountant that we would like to register a company. What should be the formality? So the chartered accountant tells you that minimum equity capital should be 2 lakh rupees. That means you three guys must bring 2 lakh rupees. Okay. Now, whatever you bring, Suppose some guy gives more money, some guy gives less money. It is irrespective of that. You show that you hold shares in the company. That is, suppose you bring in 2 lakh rupees. 2 lakh rupees will be equivalent to 20,000 shares. Because you have decided that one share is equal to 10 rupees. That is also your decision. That nobody will tell you. You can have 1 lakh rupees a share. You can have 1,000 rupees per share. One share is equal to 1,000 rupees. One share is equal to 100 rupees. One share is equal to 1 rupee. That is your prerogative. But here you have decided that one share is 20 rupees. So your chartered accountant said 2 lakh rupees is the minimum paid up capital. So how do you share this? Now 2 lakh rupees is equivalent to 20,000 shares. So yours is 40%. So suppose this is your, what's your good name?
Jasmine.
Uh,
Jasmine, sir.
Yasmin.
Jasmine.
M-I-N?
J, sir. J.
Jasmine. Okay. Sorry, sir. This?
Yes, sir.
Okay. So Jasmine holds 45%. And say another guy, say A, holds say 35%, and B holds say 20%. So total becomes 100%. Now you hold 45% or say 0.45, otherwise the estimation will go haywire. Okay, so one is full. Now out of this 20,000 shares, you will get 45% into this. Your friend A will get 20,000 into 35%. Your friend B will receive 20% of 2,000. So now you make a sum total of the shares. It is 20,000. So you are holding 9,000 shares. A is holding 7,000 shares. B is holding 4,000 shares. That is how you are holding 45%. A is holding 35%. B is holding 20%. Let us write Balaji rather than name. Can you suggest another name?
Sir, your name?
Okay, my name. Fine. Great. So we three are holding these shares, 9,000, 7,000 and 4,000. We are holding 20,000 shares of the company. That is how shareholding is decided. Now, this 20,000 share is equivalent to 2 lakh rupees. Suppose you are doing all the work and that is why you are holding 45%, but you are not bringing so much money. Suppose you are bringing only 5,000 rupees. Suppose Balaji is bringing in 1 lakh, say 70,000 rupees. Balaji is bringing maximum money. And I am not bringing so much money. So not 1 lakh 70, so 1 lakh. And I am bringing the rest. That means 95,000 rupees. So the total will become 2 lakh rupees. See, the money that we bring may not be in this ratio. But remember, this is a special case. This is a special case. Usually, this will be like 90,000 rupees and this guy will bring 70,000 rupees. I shall bring 40,000 rupees. That is how we'll be bringing 2 lakh rupees. So don't look at this earlier estimate. Look at this. That is how our shareholding is decided. So you bring in 90,000 rupees. So we allot you 90,000 divided by 10 because 10 rupees is 1 share. So you get 45%. This is means you should look not from the other side. You look from this side. You look from this side to this. As if, yeah. So you are bringing 90,000 rupees. That is why you are getting 45%. Sorry, you're getting 45%. Now Balaji is bringing 70,000 rupees. That is why he is getting 7,000 shares. That is equivalent to 35%. I am bringing only 40,000 rupees. So you are giving me only 4,000 shares. That means I am holding 20%. Why I gave this example? Because many students and many others, while determining this percentage holding, they are at a loss how to decide. I am putting in only 5,000 rupees, but I am giving so much to the company, so I must hold so much percentage. This is possible. It is not always based on the amount of money that you bring, but in your books of accounts it will be shown like this, that Yasmin is bringing 90,000 rupees. That is why he holds 45%. And Balaji is bringing 70,000 rupees. That is why he is being allocated 35%, etc., etc. Okay, that is the understanding. Now next year, and that is what is equity capital. This total 2 lakh rupees is the equity capital. This number will never come into play in your balance sheet. You may write here fully paid up equity capital, equity share capital. You can write consisting of 20,000 shares of rupees 10 each. You can write it this way, but it doesn't come in the estimation. It is just shown here. So let us wrap the text so that it's visible. Okay. Okay. So this is how it is decided. Your equity capital is this one, 2 lakh rupees. Next year, suppose I tell you that, I am also putting in so much, so I have only 20% holding. I am feeling inferior, so I want to bring in some more money. Please give me some shares. So you say, okay, don't cry. We are going to give you some shares. I bring in maybe say another say 40,000 rupees, another 40,000 rupees. So you give me 4,000 shares. 40,000 means 4,000. So you are giving him 4,000. So how much percentage I should get? Now the entire percentage is to be estimated differently. That is a different issue. I have brought in 4,000 rupees, 40,000 rupees. So our equity capital, which was 2 lakh rupees, will now become 2 lakh plus 40,000. So in our balance sheet, like here, we are writing 838. Instead, we'll write 2 lakh 40,000. Earlier year, it would be 2 lakh rupees here. Here, it would be 2 lakh 40,000 rupees. That is how everything is decided. Now, my shareholding, everybody's shareholding will change. How? Now, suppose I just write it here. Here. Now, against my name, it is now no longer 40,000. It is 80,000. Okay. So I get not for 4,000. I get 8,000 shares. Now all percentage has to be calculated based on this. Is equal to, what is the total number of shares? Sorry, let me first of all see the total number of shares. Total number of shares are now 24,000. So I get is equal to 9,000 is my share divided by this multiplied by 100. So I get 37. Sorry, Jasmine get 37.5% and Balaji gets he has 7,000 shares divided by 24,000 multiplied by 100. So this becomes this. That means 29% I receive 8,000 divided by 24,000 into 100. I get 33%. Get this? Just reduce that. Okay. So that is how the percentage goes up, down. Next year, suppose Balaji says that, you know, I'm not liking this business anymore. So I don't want to be there. I just want to quit. So you too take my shares. I don't mind. How much money you would like to give me? Then you decide that, okay, the business is now valuable. So for 70,000 shares, we can give you 5 lakh rupees. For 70,000 shares, we can give you 5 lakh rupees. Then Balaji agrees. And then he moves away. Now, Jasmine and I discuss who should get this 7,000 shares and pay him 5 lakh rupees. Now, I tell Jasmine that I don't have money. I don't want to take it. You take it and give him 5 lakh rupees. So Balaji takes 5 lakh rupees from Jasmine. This money comes from Jasmine's bank. The business is not affected. Business is not affected because this transaction happens in a drawing room, not even in company room. So Jasmine writes a check from her personal account, pays 5 lakh rupees to Balaji. Balaji goes away. Now Balaji's share goes away. So we delete his share. Now Jasmine's shareholding becomes 9,000 plus 7,000. So it becomes 16,000. See, the total number of share remains 24,000. Jasmine gets 16,000. I remain with 8,000. So Jasmine's holding becomes 66%. My holding remains 33 because mine was 33 and is still 33. That is how. And that 5 lakh rupees has nothing to do with the number of shares. That is a negotiation that Balaji has done with Jasmine, that you take these 7,000 shares and pay me whatever you like. So she paid 5 lakh rupees. If Balaji would have gone after 2 more years, perhaps that 7,000 shares would be worth 2 crore rupees. Then he would say, Jasmine, that can you give me 2 crore rupees and I'll give you the 7,000 shares. And if Jasmine would have 2 crore rupees in her bank, she would give him 2 crore rupees and get those 7,000 shares. And the percentage will remain like this. Irrespective of how much money Jasmine gives to Balaji, the shareholding remains like this because it is number of shares. You're not creating new shares. You're not destroying any shares. So instead of Balaji, suppose this does not happen. Balaji remains, but a new investor comes in. A new investor comes in, say some angel. Angel 1 comes in and he invests, say 1 crore rupees. He invests 1 crore rupees. But he wants 20% of the company. He straightforward wants 20%. Nothing beyond that. Just 20%. Give me 20% of the company. So now you have to give him some shares, either from the existing shares or you create new shares and give him. So suppose you create some new shares. Say you create some shares. You do not know how much. How much share you should create? Listen to this very carefully. See, this 24,000 shares will now become only 80% of the company. 80% of the total equity. Jasmine, are you following? This share will remain with 3 of you. These shares will remain with 3 of you. But now Angel holds 20%. So how much you 3 holds? 80%, remaining 80%. So this is equal to 80%. So total number of shares will be is equal to this divided by 0.8 is equal to this. 30,000 will become total shares. So I write here 30,000. Okay, forget about this part. I write here 30,000. And Angel holds 20% of that. So Angel holds is equal to 0.2 multiplied by this is equal to this. And you will remain holding 9,000, Balaji 7,000, I 8,000, but our holding now changes to this. It has already modified. This guy holds 20%. Right? That is how it changes. I hope this is clear.
Yes, sir.
Okay, great. Any other question? It took half an hour.
Sir,
Bolo?
sir, but in this year, assume that the value of each share remains constant, right?
10 rupees. Value means face value or par value, that never changes. But market value changes. When the angel came and invested 1 crore rupees for 20%, he received only 6,000 shares. By paying 1 crore rupees, he received only 6,000 shares. Because one share is now highly valuable in the market, but the face value remains 10 rupees. So you have to understand that. It's slightly difficult, but not so difficult. You have to think more. Now see the video and see the Excel sheet. I'll share immediately, and then you should think over. You'll get it. Some thought is necessary. But if there is residual doubt, I'll be clarifying that. Though I'm not feeling like talking anymore. Any other question?
Sir, can we say that the market value of each share is 1 crore by 6,000?
Right. Absolutely right. Market value of each share is 1 crore divided by 6,000. So if somebody, suppose your dad or your uncle or father-in-law wants to invest in your company now, looking at that your company is doing wonderful, and your somebody says that, or a friend says that, give me some 100 shares, I want to invest in your company. Then the polite thing to tell him will be that, our one share is valued 1 crore. Is it 1 crore? 1 crore. Yeah. So is equal to 1 crore divided by 6,000 is 1,666 rupees. One share. So 100 share is 16,660. So you tell him that, okay, you take 100 shares, but you have to pay 16,666 rupees that you got for 10 rupees. 10 rupees share is now in the market selling at 16,666. So any friend who did not pay heed when he wanted money and in excess for 10 rupees share, now they have to cough up 16,666 to get 10 shares. Sorry, 100 shares means this into 100. So that is going to be substantial. 1,66,000. One share that you received by paying only 10 rupees is now worth 1,66,666 rupees. Not one share, 100 shares. 100 shares. You got 100 shares for 1,000 rupees. Right? Any other question? Any other question? Go ahead if there is any other question, or else we call it a day. Then I'll share the video.